Hello, hi students. In this video, we'll continue on Ind AS 116 accounting for leases. So, in this chapter, we will cover on how to account the leases in the books of lessor. So, here we specifically cover the lease classification into finance lease and operating lease, and we'll go through few specific examples of how to account the leases in the books of lessor, and also we'll try to cover few important sums on how to account the leases in the books of lessee. Okay. Yeah, so accounting for lease in the books of lessor. So here we have to classify the leases between operating lease and finance lease. So this is important from lessor point of view, where the lessor needs to classify the leases into either operating lease or finance lease. Okay, so here it's one important note is that this classification of operating lease or finance lease is relevant only in the hands of lessor, but it is not relevant in the hands of lessee. Okay, so prior to Ind AS 116, we used to have Ind AS 17. So under Ind AS 17, it was even important for the lessee to classify the leases between operating lease and finance lease, but that is bit old concept, and Ind AS 116 have completely replaced Ind AS 17. So under Ind AS 116, lessee don't have to categorize the leases between operating lease and finance lease. Only lessor needs to classify the leases between operating lease and finance lease. So just for your information. And let's see what is the operating lease and what is the finance lease. So it's important. So operating lease is a lease that does not transfer substantially all the risks and rewards incidental to ownership of an underlying asset. So this is important. So for operating lease is a lease that does not transfer substantially all the rights and rewards incidental to ownership of the underlying asset. So meaning that in the operating lease, the asset will remain in the books of lessor even after the lease term or through, the asset will become ownership of the lessor. So it will not be transferred to lessee. Okay. And for finance lease, it's a lease that it ensures transfer of substantially all the risks and rewards incidental to ownership of an underlying asset. So under finance lease, the lessee will become ultimately the owner of the leased property or the underlying asset at the end of the lease term. Right. So the majority of the economic life of the underlying assets will be leased out. So after the lease term, lessor will virtually have nothing from the underlying asset. So the most of the economic life of the underlying asset is being leased out to the lessee. So eventually lessee for all purpose will be the owner of the asset. That's why lessee have to account for a right to use of asset. So they used to capitalize the leased assets and leased liability because it's treated as though it's a finance lease. And from lessor perspective, we'll go through how the finance lease will be accounted. Okay. So now, in addition to the specific classification of the operating lease and finance lease, the finance lease, there are few specific situations where if the lease agreement fulfills those specific terms, then even those leases will be termed as finance lease. Let's go through. There are three cases where if the lessee have this kind of rights, then the lease will be termed as finance lease. Okay, so loss on cancellation. So if contractually lessee has to bear 100% loss to lessor on account of the lease cancellation. So if that contract clause is available in the lease agreement, then it's a finance lease. So here the lessee gives assurance to lessor that the lessee will bear 100% compensation of any loss on account of cancellation of lease, then it will be termed as finance lease. And second term is fair value of the residual asset. So here if lessee has the right on gain or loss on the fair value of the underlying asset at the end of the lease term. Okay, so at the end of the lease term, if any gain or loss on the fair value of the underlying asset is to the account of lessee, then that situation also will be termed as finance lease. Then the third one is option to extend the lease. If lessee has a right to extend the lease at the rent much lesser than the market value, then that situation also will be part of finance lease. Okay, then we'll go through some specific example with respect to land and building. So because practically you will be seeing most of the leases towards land and building will happen. So here you have land as well as building. So somehow you have to allocate the consideration or the rental between land and building, and whether the land and building lease will be finance lease or operating lease, that we can go through here. So for a leases that consist of land and building, the lessor has to separately assess the each element. So for land and building, land separately and building separately needs to be assessed between finance and operating lease. Okay, it is not that you can assess together, but you have to assess separately under Ind AS 116. And lessor to allocate the lease rent between land and building in proportion to the retrospective fair value at the inception of the lease. So at the inception of the lease, you will be knowing the fair value of the land and fair value of the building. So based on the proportion, you have to allocate the lease rental between land and building, so that you will have the separate value to assess, and based on that assessment you can categorize whether the land and building lease is operating lease or finance lease. But in some cases land value might be immaterial, so then lessor allowed to take both land and building together as a single element and then do the assessment. Okay, so generally land has indefinite economic value, but building has definite economic value. So, and if building is leased for its substantial life of its economic value, then lease can be classified as finance lease. Okay, suppose if a building have 25 years useful life, and the lease is for the entire 25 years, then we can classify this as a finance lease, because the 100% of the economic life of the building has been leased out. And probably land will have, even though it has economic value, it might be immaterial in this particular example. So land and building can be clubbed together, and since building has been leased out for the entire economic life of its building, then it will be a finance lease. Okay, so having said that, we'll see how to account the finance lease, how to recognize the finance lease in the books of lessor. Okay, so at the commencement date, at the lease commencement date, a lessor shall recognize assets held under a finance lease in the balance sheet and present them as a receivable at the amount equal to the net investment in the lease. So this is important. So generally, as in land and building, the lessor is owning, but once a lease agreement is signed off and it's a finance lease, so which means that eventually the land and building is being sold by the lessor to the lessee. So that's the conclusion. So finance lease means the majority of the economic life of the building is being sold to the lessee. So in such a case, the lessor will not account those land and building as land and building. Okay, instead of accounting them as land and building or the property, plant and equipment, it should be accounted as the receivable in the balance sheet of the lessor, and the receivable value will be equal to the net investment in the lease value. So that's important in the books of lessor point of view, that once the finance lease have been signed off, then the asset loses its original style, and even though land, building, like that, you have a property, plant and equipment, and if that is leased out as part of finance lease term, then you will not continue accounting of those assets as property, plant and equipment. Instead, you have to account those leases or those assets as receivable, lease receivable in the balance sheet of the lessor. So the step is you have to de-recognize the carrying amount of the underlying asset. So land and building, whatever it is, you have to de-recognize it. So you will not continue to disclose them as the property, plant and equipment, and recognize them at the net investment in the lease. and recognize remaining in the profit and loss account as the selling profit or loss. So any difference between the carrying value and the net investment value, there could be profit or loss. That profit or loss can be recognized into P&L. Okay, so let's see, the net investment in lease is equal to the present value of the lease payment. So you have to compute the present value of the all lease payment over the finance lease period plus present value of the residual value. So at the end of the lease term, if there are any residual value, and what is the present value, so together, so present value of lease payment plus present value of residual value together will be the net investment in lease. Okay, and how to compute selling profit or loss? Selling profit or loss is equal to your fair value of the underlying asset or the fair value of the lease receivable, whichever is less, minus your carrying amount of the underlying asset will be your selling profit or loss. Okay, but here you have to one small catch. So if a manufacturer leases out one of its property, plant and equipment or machinery, then he is a manufacturer, so his sole motto of the business is to manufacture certain machineries and then sell to the customer. So here, if it is sold on a finance lease basis, then it's actually a sale, so you have to recognize profit or loss, and it will be recognized at gross level, meaning you have to recognize your turnover as revenue and the manufacturing cost of the machinery or the carrying value of the machinery as your direct cost. So instead of recording the profit or loss directly into the P&L for manufacturer or the dealer manufacturer, you have to recognize revenue as turnover of your the entire lease rental to be received, and you can recognize the carrying value of the asset as your cost. So your turnover will be increased in this model. But this is allowed only to manufacturer and not to the regular investments. Okay, so we'll go through one example how to account the leases in the books of lessor. Okay, so in this example, a dealer lessor enters into a 10-year lease of an equipment with the lessee. The equipment is not specialized in nature and is expected to have alternate use to lessor at the end of the 10th year lease term. And under the lease, lessor receives annual lease payment of rupees 15,000 payable at the end of the year, and lessor expects the residual value of the equipment to be 50,000 rupees at the end of the 10th year lease term, and lessee provides a residual value guarantee that protect lessor from the first 30,000 rupees of loss for a sale of a price below the estimated residual value at the end of the lease term, that is 50,000. The equipment has an estimated remaining economic life of 15 years. So after 10 years, it has still have remaining economic life of 15 years. A carrying amount of 1 lakh. Okay, a carrying amount is 1 lakh and the fair value is 1,11,000. Okay. And the lease does not transfer ownership of the underlying asset to lessee at the end of the lease term or contain an option to purchase the underlying asset. And implicit interest rate is 10.078%. So these things have been given. So let's see whether it's a finance lease or operating lease, and if finance lease, how to account them. Okay, so here you can see these are the lease payments. So every year at the end of the year, you have to pay, the lessee has to pay to the lessor 15,000 rupees. So for the 10 years, we have plotted 15,000 rupees yearly. And last year there is another 30,000, which is the guaranteed residual value. Okay, and given the present value, the discount rate at 10.078%, and if you apply 10.078%, you will get, these are the discounting factor. So 1 by 1 plus 10.078% will give you 0.908, and 0.908 divided by 1 plus 10.078% will give 0.825. So like that, if you calculate, you will have all these values. Okay, So present value of the first year 15,000 is actually 13,620, multiplication of 15,000 into 0.908. So like that you have to calculate present value of all the 10 years, including last year the residual value, that comes to 11,480. So altogether you have a total present value of 1,03,340 in this case. Okay, and after the present value of all the lease payment plus guaranteed residual value, you also have the unguaranteed residual value of 20,000 rupees. And even if you calculate unguaranteed residual value, present value at 0.383, you will get 7,660, which means the total present value including the guaranteed residual value plus unguaranteed residual value is equal to 1,11,000, which is 1,03,340 to be paid by lessee to lessor, and 7,660 which is unguaranteed residual value. Together you have 1,11,000. Okay, so in this case, this since 1,11,000 is equal to the majority of the fair value of the leased assets, we can conclude this as a finance lease. Okay, because majority of the expected fair value of the leased assets, underlying asset, is being recovered through this deal, so it's a finance lease. Okay, so once it is concluded as a finance lease, so lessor will account like this. So you have to recognize the investment in the lease as a receivable of 1,11,000, and then you have to recognize cost of goods sold at 92,340, and the revenue is 1,03,340, and then property held for lease is 1 lakh. That's the carrying value of the asset. Okay, so this is a journal entry we have to make. Then at every year end, what we have to do, first year you are getting 15,000 rupees as cash, you can debit 15,000 as cash, and then your interest income 3,813. I'll tell you how this 3,813 is worked out. So interest income is 11,187, and then the net investment in lease is reduced by 3,813. Okay, if you go through this table where you have the present value of 1,11,000 rupees, and then every year 15,000 is getting paid, right? And then you have to calculate the interest income. So interest income at 10.098% of the opening balance on 1,11,000, 10.098%, you will get 11,187 as interest income. So that's what it is credited here. So second year interest income is 10,802, which is on 1,07,187. If you calculate 10.087%, you will get this. So like that, every year you have to calculate the interest, and you will credit the interest income by that amount every year. And the net investment in lease is getting reduced like this. So your opening balance minus your payment plus your interest, you will get this. So your closing balance minus opening balance will be the reduction of net investment in lease. So this is how we have to make entries every year. Okay, done. So that was the example on the finance lease. Now we will move to operating lease. So operating lease, it's a very simple concept. So here the lessor recognizes the lease payment from operating lease as income on either a straight line basis. So you can recognize income on a straight line basis, meaning as and when the lessee pays rental to the lessor, the rental income will be recognized on a straight line basis. Or if any other systematic basis is available, which is much more comprehensive than the straight line method, even that method is also allowed. Okay, so that's on the operating lease. Now I will run through few important exam questions. Okay, maybe you can just go through this illustration, take few minutes and read this illustration. So I will try to summarize the question here. So here lessee enters into 3-year lease of retail space on 1st April 2017 till 31st March 2020. So that's the lease term. and lease rent is 200,000 per year due at each year end. Okay, and lessee used to follow old Ind AS 17 up to 31st March 2019, and from 1st April 2019 mandated to follow Ind AS 116, thus requires transition. So there are three transition approaches are available. One is called a full retrospective transition, modified retrospective transition. Under that modified retrospective, there is alternate one and alternate two. Okay, and here the incremental borrowing at commencement was at 12% and at transition was at 10%, and depreciation calculated on straight line method. Okay, so now we'll have to do the full retrospective approach and then modified retrospective approach, alternate one and alternate two. Okay, so first we'll go through full retrospective approach. So it's very easy. So under full retrospective approach, it's given that the present value is 12%. Okay, and every year 200,000 is your lease payment. So you can calculate what is the present value of this 200,000 yearly. Okay, so present value using the original discount rate of 12%. So you can get these values. So 1 by 1.12 you will get this, and 0.8929 by 1.12 you will get this. Okay, so 200,000 multiplied by the present value factor, you will get 178, 159 and 142. So altogether 4,80,380. So this is the present value. Should have the ROE assets and liability should have been recognized under the full retrospective method. Okay, so this is one. So from 480 you can calculate the ROE assets, ROE liability, depreciation, interest expense, everything. Okay, under the alternate method 1. Okay, I'll go to the alternate method 1. So here alternate method 1. So here instead of 12% discount factor, you can take the discount factor, the current discount factor at the effective date, that is at 10%. So you have to calculate at 10% what should be the ROE assets and liability. Okay, so if you do at 10%, you will get 497,360 as your ROE asset. Okay, so here is the working. So you have 200,000 every year. So you are discounting at 10%. So you will get these values. So all together you will get 497,380. So 497,360 should be your ROE assets and liability. Okay, so your ROE assets and liability at the beginning is 497,360. Then you have to calculate your interest expense. Interest expense is at 10%, and then you are paying 200,000. Okay, so your lease liability will get reduced by opening balance plus interest minus lease payment. You will get the closing lease liability like this, and the interest expense for second year will be 10% on the opening balance, and depreciation every year will be on a straight line method. This 497,360 divided by 3. Right. Okay, so here you have a hit of retained earnings by 16,019. That's the transition balance difference. Okay, so basically you'll have to compute what is your opening balance as of 1st April 2019 as per your old method, and as per the new method the difference to P&L will come to 16,019. Maybe I will also quickly run through how this difference can be computed. Yeah, so this is how it will be computed. So on 2017-18 your rent is 2 lakh. It was charged off to P&L as per the original method, and 17-18 interest is this much and depreciation is this much. So total P&L charge will be 217,772. So which is 57,646 plus 160, 126. Okay, so difference between these two methods comes to 17,772. So like that you have to compute as on the transaction date how much already charged off to P&L and how much is supposed to be charged after P&L. So delta between these two will have into retained earnings. Okay, probably I also given summary of all the three models here. So under the full retrospective method, your ROE asset is 160, 126 and lease liability is 178, 589 and cash lease payment is 200,000. Interest expense is 21, 411. Depreciation is 180, 127 and total periodic expenses 181, 538. And alternate method 1, your ROE asset is only 165, 787 because here you are depreciating at your interest at 10% and lease liability is 181, 806 and cash lease payment is 200,000. So interest expense is come down 18,194 and depreciation is a little bit increased. And the alternate method 2, where you are doing only prospectively, your ROE asset is 181, 820 and liability is also 181, 820 and your cash lease payment 200,000, interest expense 18,180 and depreciation is 181, 820. Okay, so now I will move on to the next sum. Okay, so let's go through this exam. Probably you can take some time to read this question. Okay, I have tried to summarize this question here. So here entity A is a lessee, leases dedicated production line from entity B, lessor, okay, for 3 years. Okay, and rent is 240 per unit for first 100,000 units. 100,000 unit up to 120 units, the rent is given as 240 per unit per month. And it will be increased to 246 per unit if the quantity is more than 120,000 units per month. And minimum order quantity is given as 100,000 units per month. And cost to entity B is 195 per unit, that's the job cost. And standalone rent is 60 lakh per month. Okay, and discount rate is given for entity A is 10% and a dedicated to separate the lease and A decided to separate the lease and non-lease component and calculate the lease and non-lease, allocate the consideration, calculate ROU and recognize in books. So that's the summary of the question. Okay, so here how to identify the lease and non-lease component and allocation of consideration into these components. So in this case, the agreement contains lease component, that is a production line, and non-lease component, that's a job work. Okay, and entity A has not elected to apply the practical expedient as provided in paragraph 15 of Ind AS 116. So it will separate the lease and non-lease component and allocate the total consideration to the lease and non-lease component in the ratio of their relative standalone selling price. So in the ratio of their relative standalone selling price. Okay, as entity A is required to purchase minimum 100,000 units per month at the rate of 240 per unit, there is a substance fixed payment of 2 crore 40 lakhs per month. Although the payment are structured as variable lease payment, there is no genuine variability in those payments as entity A is required to purchase a minimum quantity of 100,000 units per month, that is 2 crore 40 lakhs per month. Okay, so the observable standalone price for these lease component is 60 lakhs because they have given very clearly that the standalone price of the lease is 60 lakhs. The observable standalone price of the non-lease component is 1 crore 95 lakhs because that's also given. The job work cost value is 195 per unit and for the minimum order quantity of 100,000 per unit, it will come to 1 crore 95 lakh. So the observable standalone lease component is 60 lakhs and observable standalone non-lease component is 1 crore 95 lakh. So total come to 2 crore 55 lakhs and the percentage of lease component on the total comes to 23.53%. Okay, so this is the ratio. So now we have to allocate the consideration of the lease component to this 2 crore 40 lakhs, which is the minimum order quantity of 100,000 and the lease value of or the consideration value of 240. So the total comes to 2 crore 40. So how to allocate this 2 crore 40 between lease component and non-lease component? So you can take 23.53% of 2 crore 40 lakhs, that will become the lease component and remaining will be the non-lease component. Okay, so that's how we can allocate. And once allocated, so the total allocation for a year will be 6 crore 77 lakh 67,400. So that is your lease value of 56 lakh 47,200 per month into 12 months. And as entity is incremental borrowing rate is 10%, it discount lease payment using this rate and lease liability commencement date is calculated as follows. So your 6 crore 77 lakh 66,400 multiplied by 2.49. So this 2.49 is the 3-year discount rate at 10%. So if you calculate year by year and sum it up, you will get 2.49 as the discounting factor. So if you apply, you will get the total present value of the lease liability will be 16 crore 87 lakh 38,336. So this value will be the ROE asset and ROE liability in the books of entity A being lessee. Okay, and the remaining payment. So remaining payment 2 crore 40 lakh minus this 56 lakh 47,200 per month. The remaining is 1 crore 83 lakh 52,800. So this will be charged to P&L directly as part of the job work charges. So this will not be part of your ROE assets and liability calculation. So this is a non-lease component. Non-lease component will be charged to P&L directly. Okay, so with this I will conclude today's class. We'll catch up again in a new chapter in the next week.